watching Your Money Matters here at NDTV Profit. I am Mahima Vajrajani and we're going to do a very interesting conversation today. How Indians invest their money is quietly changing the country's economic future. Households are now moving from savings to investing, from deposit to markets, and from short-term trades to long-term wealth creation. But India still allocates far less to capital markets than global peers, making the shift both transformative as well as a little unfinished. So what does this evolution really mean for investors, markets, and India's growth story? And to exactly decode this, we're joined by Rakesh, who's a partner at Bain Company, and Harsh Jain, who's the co-founder and Chief of Operations at Groww, joining us now. Rakesh and Harsh, thank you so much for taking out the time and speaking with us at NDTV Profit. Rakesh, I'll take up the first question with you. In terms of India's capital market allocation gap versus the developed economies, that is massive, right? But what are the top two structural constraints that you think could kind of slow down this conversion despite of a strong investor interest?
Hi, Mahima. It's a pleasure to be here. No, great question. I think first, let me just touch upon the opportunity before I come to the constraints. But we are, despite all the growth we've seen post-pandemic, we are still at about 10% household penetration for mutual funds. And that's at exponential growth that we have seen. What we think we need to get to for us to get to Viksit Bharat in 2047 is about 35% penetration. What's interesting is while the number of investors have gone up, what hasn't particularly gone up is the per capita AUM. So the growth in per capita assets has not necessarily happened, and that's just a compounding effect because people are new. Our growth is driven by new investors coming in as opposed to people compounding their wealth. So that percentage of AUM in mutual funds as a percentage of GDP is still around 13% or so. Just as a benchmark, it's 80 to 100% and north of 100% for some mature economies where capital markets have really matured. We think that number can get to 80%, and we'll have to get to 80% by 2047 for us to achieve that Viksit Bharat ambition that we've got. So it is a massive opportunity. Now, coming to your question on structural constraints, I think one is, of course, that a lot of it is predicated on the compounding effect I spoke about. So if there are sort of impediments in between which sort of impacts the returns that you get in the 2 to 3 year time frame, which is usually the cycles that we follow here, then there could be a small but significant part of the market that could maybe not stay invested. I think what's encouraging is when we look at the data, people who are staying longer has significantly gone up versus, say, 2020. So I hope that trend continues and people believe in the long-term confidence of the markets. But that's something to just keep an eye out for, especially with 10% penetration go to 35%. So that's 25% of the country coming into this fold and who are going to be relatively new to this. I think that could be one big constraint if the markets behave, in a volatile manner as it would, over smaller periods. There could be a portion of investors who could get taken aback. The other structural constraint is we need to find a way to get to, beyond 100 cities. I think beyond 30 cities, now the next 70 cities, thanks to platforms like Groww and Zerodha, we've done a tremendous job. And really this Choti SIP and investing in smaller amounts has really held us in good stead there. But getting beyond tier 2 cities, beyond the top 100 cities, at a business model that is viable for these suppliers, which could be distributors as well as manufacturers, would be an important consideration. And that's something that we saw, or I've seen with UPI as well, right? So we've seen the growth there, but there's still 60% cash in P2M transactions. So to get that to 30%, you really need to get to tier 3, tier 4, tier 5, tier 6 cities. And that could be an interesting challenge to tackle going forward.
Absolutely. I think just taking that point ahead with Harsh. Harsh, what Rakesh just mentioned with regards to expanding now more in terms of tier 3, tier 4, tier 5 cities, what do you think platforms like Groww can do in order to reach a wider audience? Because there are multiple initiatives, of course, that platforms like Groww has already taken in terms of Choti SIP, like Rakesh mentioned. But how is it that you are adopting as a strategy to now expand beyond the tier 2 cities?
Yeah, thanks, Amima. Thanks for having me here. I'll just take a step back and say that there are like multiple things, that happened in the last 5, 10 years, and we can see how the trend's going to go and how everyone will play their role. I think one thing was the market performance, I mean, obviously, India in long term will continue growing. That's our belief. That's what we are building for, right from the policies to the structural changes in the investments that we're making. So when the markets perform well, it becomes an alternate for people to build their wealth from. The second was the regulatory changes that happened over the last 10 years. I think making it a safer and a comfortable and a transparent investment opportunity in a vehicle, and also to avoid the distractions of the other things. So regulators played a lot of role in making it safer for people to do. And third was where we also played our role, was to make it accessible. Whether it's a tier 2, tier 3, whether it's a English, Hindi versus so many regional languages that we have in our country, versus making it a very hardcore person who understand all the financial terms and jargons to a person who is just starting their investing journey, and also having access to laptop to mobile to a human, all that, making it accessible was the third leg the third piece in the picture, which completed it and made it easy for people to be able to participate. And when I see going forward, all these three things need to be there at a longer term to be able to build this and continue this penetration. And tier 2, tier 3, tier 4, I think it's a natural adoption that is going to happen. But with the last 5, 7 years, with content, with internet, with mobile, the information has penetrated to every nook and corner of the country. The access to be able to invest in any of the mutual funds or buy any stocks or do any of the capital market transaction is alike, whether it's a tier 3, tier 4 or tier 1. So I think the boundaries will blur a lot, and people will just start talking around, and then their communities, their social circles will also start understanding the benefits of it, and then they'll keep on participating. So the penetration is going to go up from where it is not done happened before. And tier 2, tier 3, tier 4 have been the areas where they traditionally were less penetrated. So now we are seeing that penetration going up.
Interesting. Your data also shows that Gen Z is both the fastest growing and most reactive cohort. Now, Harsh, this question is to you. How should platforms balance the kind of engagement nudges with investor protection for this particular segment? Because we've seen, and there's data out there suggesting that these are the people who are trying to take more risk, going ahead, doing F&O. I mean, I just want to understand as to what should be the kind of message that you would want to give via this platform to that particular cohort.
Yeah, so there's a lot of participation from the Gen Z or the younger folks, but if you look at the presence on each product, like for example, you talked about F&O, right? So there are approximately 30 lakh people in the country doing, and if you see the participation across the 7 crore people who are investing in stocks and mutual funds and other capital markets, so that's a small niche of people, and they're not overrepresented by younger and older. So I think the two things are very separate. How the participation, awareness, knowledge is increasing amongst the younger folks. Now, when we go to college and we talk to people, there are people who are doing SIPs in college, where one narrative is that they're all spending. But then, when you go and meet people, they're actually people who are saving from their pocket money, or they're doing side gigs like a small internship or helping some of the companies or some of the projects making money and putting them in mutual funds. So, from their extreme to people trying to get into the capital market with their, if you see the YouTube finance content contribute, like the adoption and the audience, you will see far significant bias for the younger age. So people are curious, they're hungry, because they've realized now, it's not just something that only people in 40s or having tons of money or access to financial hardcore financial people who can only invest. Now everyone and anyone can invest. So that's how they're starting their journey. So it's a good movement. People are becoming aware. They're diversifying their investments early on. And when they get serious money and they're able to increase their investments over time, they'll get significant benefits from this habit.
Okay. Rakesh, the other aspect is SIPs. There's always a debate whether it should be SIPs or lump sum investments. While, SIPs appear structurally, sticky, lump sum is more opportunistic, right? Should the industry actively encourage lump sum discipline, or is volatility-based timing actually healthy with the kind of market behavior that we've seen? And this is especially, again, for the cohort that's been very active, the Gen Zs, the young generation that we're looking at right now.
Yeah, I think just going back to Harsh's point as well, our data also shows that SIPs have grown from 19% of mutual fund AUM like to 31% in the last few years, 5 years or so. And I think we have to cross two stages. So India is at a stage where we have to get to that culture of saving and investing. So financialization of savings to investing. That's step one. And then step two is then diversification, staying put, etc., and understanding different options better. And particularly on the segment that you mentioned, which is Gen Z, presumably in the top 30, top 70, top 100 cities, these are people who have just about, in colleges, or just early jobbers entering the workforce, etc. And the discretionary income that they've got, first let's build a culture of investing, and investing as a discipline as opposed to, when you've got some excess inflow. I think both are required, but that discipline creates a lot of value, compounding value over a long time. So where we are at as a country, for the reasons you mentioned, because of volatility, because of just the awareness and education required on the amount of options out there, and where you start versus where you end up, I would still strongly suggest that for someone starting out, there would still be that SIP sort of induction phase, if you like, to be there for a while before you get into more complex structured products and think about lump sum investing. I think lump sum is always a great idea, but if you've got the liquidity for it, by all means, but think about diversification strongly and think about long-term investing, staying put in the markets, as opposed to speculative behaviors.
As Harsh was mentioning, there's also a lot of social media influence when it comes to, making people aware with regards to investments. At the same time, social media is both boon and bane, right? We've seen a sharp increase in terms of mid caps, small caps, thematic allocations. Do you think that this reflects a genuine risk understanding? Because a lot of digital content is kind of driving this kind of moves in the market, especially when NFOs are concerned. A lot of thematic NFOs come into picture and are being subscribed. So what's the view there, Rakesh?
I think, for the stage of evolution we are at, we will need a mix. It's difficult to say, flexi cap versus small cap versus, mid cap, what's the right, but you'll need the right mix. I think the good news is, with the moves that SEBI has made, hopefully a lot of the unregistered, unqualified sort of advisors online get addressed in a big way. And you really have some sort of qualification before you get to advise people on this. That's one. Second, I think the view on one interesting data point, right? We were almost negligible on passives about a few years back. Now, of the overall market, passives is about 17% of mutual funds, and within retail, it's about 7%. I mean, you can expect the institutional investors to invest a lot in passives, but we're seeing retail investors get into passives and ETFs in a big way. For comparison, it's about 50% in the US. And increasingly, as the market matures, we will start seeing sort of large caps give almost the same performance as a passive and index funds and ETFs. So I do expect retail investors to, if you fundamentally believe in the growth story of the market, to put more money into passives and that to grow to about 20% or so in the next 5 years from where it is right now. So I would say it's both. So there will be that sort of risk-seeking segment who will try and over leverage on the small caps and mid caps. But I do see that opposite trend happening as well, and people, increasing their exposure to passives and having a more diversified balance strategy.
Understood. Harsh, the next question to you is with regards to SEBI's tightening of a lot of F&O norms, and which is required, right? It is kind of pushing investors towards long-term investing. But do you think that now the kind of rules in place are enough to regulate the F&O market? Is it excessive? Is it less? What is the view like? And if these rules get stricter going forward, do you think it has a risk of pushing people to informal or unregulated channels?
So I believe the regulation and making the industry, safe and effective and efficient is not a one-time, one-step thing. It's a continuous, and it's not just one of the regulation that probably, you're referring to, but there have been tens of regulations which have come in the last few years, and I believe that they'll keep on coming over the next decade also. And it's a continuous process to keep on looking out what behavior changes are happening and which of the behavior changes are progressive and which of them might be risky, and then keep working on it. So are we good today? Were we better off yesterday? Will we be better off tomorrow? I think it's a journey that keep on happening because our country is very it's still growing, and the penetration, adoption, still today there'll be a lot of asset classes which are not even present today, which will come in new, and they'll bring their new challenges when they come in, right? So this is a process which will continue happening, and I'm happy that our regulators are at least so proactive and they are so participative in the industry that they are keeping an eye, looking at the data, they're discussing with the industry participants, taking a they're releasing consultation papers, so many consultation where their participation is going up, and they're able to build something which changes the and which makes it even better. So it's a second leg, and a very important leg in the growth of an industry. If you make it safe and build trust and transparency, then there will be people who would want to come in and stay for long.
Absolutely, makes sense. Rakesh, with regards to retail investors, they are now becoming market stabilizers, right? Now, do you think policy should begin treating them as systematic asset class rather than just participants? Do you think there is some changes that needs to be brought about?
Well, I won't be qualified to answer that, but the data shows that especially in a market like India, the amount of resilience that retail investors bring to the markets, now we've proven with data. So about 10 years back, when the Chinese yuan the crisis hit, we took about 4 or 5 months to recover, and the retail participation was almost negligible. Now we have seen a couple of shocks with COVID, with everything that happened geopolitically this year. We are seeing the markets bounce back much quicker, from 5 weeks, 6 weeks to 8 weeks. And the only thing that has changed between then and now, or the most significant thing that has changed, is really retail investor participation. But, whether they should be treated differently, etc., Mahima, that's for a different discussion. I won't be qualified to comment on that.
All right. So Harsh, the other question is that if retail investing is, kind of foundational to achieving the $30 trillion economy that we're aiming at, what is the single biggest reform in terms of policy or tax or structure that India still hasn't implemented?
So I would believe there are a lot more asset classes which are traditionally popular among Indians. I think that real estate, gold, and I mean, you will see the trillions of dollars which is lying in these asset classes with the retail people itself. I think there is a way for that to be more structured, more available and accessible for retail investors to participate and build their growth in the products through the products which they are more familiar with. That will build another orbital jump in the country.
Okay, Rakesh, how do we ensure that the wealth that's being created through capital markets translates into household financial security, and this becomes a habit rather than just being episodic market participation?
Yeah, and I think this is where we have taken the right steps as well with Choti SIP, the mutual funds IEA campaigns, and so definitely a lot of credit goes to AMFI, SEBI, and all the market participants in how we have made that jump. It's really slow but steady kind of progress. I think the point to make is super critical, though, that it has to be episodic, disciplined, long term, and not one time kind of thing. I think the steps we take, I think there has to be constant monitoring of retail investor participation at the right geographic segmental levels to understand by different patterns of not just demographic but other segmentation as well, to understand wealth creation and channels through which they've invested and how that is translated into wealth creation versus erosion for the country. And that monitoring will give us the right lessons and the right interventions to make as we go along, especially when we expand beyond tier 3, tier 4 cities. That becomes super critical. And as we all agree, you will need that phygital distribution channel, phygital distribution capability to expand beyond the tier 3, tier 4 cities. And therefore, then data tracking and monitoring become even more challenging when you have a phygital model, but it's super critical to make sure that we take the right interventions basis data.
All right. Just one last question. This is for the both of you. I'll take this up with you, Harsh, first. If we were to publish, you've already published how India invests 2025, but if you were to publish 2035, what is the metric that would best indicate that India has truly matured as a nation? What would that one thing be?
So I would say active investors in the capital market.
Okay, and the same question for Rakesh, you as well?
Yeah, no, I agree. I think one would be just household penetration of any sort of capital market products. And second would be the product per customer. What we now actively track in banking, there's probably an equivalent thing to be done in capital markets as well. But that'll truly tell us the maturity, because it's not just how many people invest, but what's the diversification, right? The awareness and diversification across a set of product classes. That's something that we should look at in 10 years and 20 years.
Right. Well, Rakesh and Harsh, thank you so much for taking out the time and giving us those insights. I'm sure this helped every different investor that is watching this. So thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you so much.
Thank you. Thanks, Mahima.
All right, so that brings us to an end of this edition of Your Money Matters. But do stay tuned. More news and update on the other side.